Hey all, welcome to our second episode, or what should be our second episode of Caffeine Fueled Ventures. Now that is a tongue twister, but welcome. So just to remind you, or fill in some of the gaps of who we are and why we're here, to share some of the knowledge we've gained. So we spent the last 3 years growing our business, exploring different parts of selling online, whether it be Etsy platforms, Amazon, own website, array of different avenues. And we want to basically share what we've learned over the last three and a bit years at this point, with you, what we can based on our knowledge that we've gained over that time. We can go into a bit more detail another time as to what has been super good for us and not been so good. But yeah, today what we wanted to cover was what it's like to start a UK business, and I am joined by my co-host and business partner Rory. Hey again, Rory, welcome. And we're in for some fun, right? So today we're going to be covering what it's about to start a UK business. Is it simple? Is it chaos? What do you need to know? And we're going to keep very UK focused. So for those that might be watching from overseas, if we have any of you, welcome. You are obviously welcome to enjoy the episode, and you may find some interesting business practices about the UK. So yeah, Rory's going to lead us off with the different types of businesses you could run in the UK.
Yeah, thanks, Jake. I guess as well, one of the things that might be worth mentioning as well is that Jake and I both have full-time corporate jobs that are really important to us, and that might also dictate how you'd want to set up your company. So remember that we're coming from this at the angle that we have full-time corporate jobs, and we needed to set up a business that we're able to do evenings and weekends and mornings and all that kind of stuff, and that kind of might have informed the type of setup that we might have had in the beginning. So
that's such a good point, to be fair, man, because when you've already got a main source of income coming in, it does potentially it potentially moves you from one type of setup to another, right?
Absolutely. I mean, if you take, for example, and it's a really good segue, if you take, for example, sole trader or a partnership, with that type of entity, the money that the business is bringing in goes to you directly. And the issue with that is there are certain tax implications. And actually, we should probably start right off the bat. Neither Jake or I are an accountant. And so please don't view this as tax or financial advice. It's merely what we've learned along the way. But if you do have, a full-time job and you are looking to start a business here in the UK, certainly look into sole trader or a partnership. But remember that the money that comes into that business, so the revenue that business generates, becomes yours instantly. And therefore, you have to go and you have to fill in self-assessment tax forms each year. Now, don't get me wrong, actually, that's probably less paperwork than with a limited company. But of course, there's instant tax implications for doing that. It becomes a second job, essentially. So that kind of nicely leads me on to my next point, really. What are the kind of options for you if you were looking to open your own business here in the UK? So as I mentioned, you've got your sole trader, you've got a partnership, and then you've got a limited liability company. Those are the main three. There are more you can incorporate, you can go public. There are more structures, but just, the likelihood is you'll be choosing between these three. Now, straight away, I can tell you why, sole trader was no good for Jake and I, because we're not sole traders. We are not going into this business alone. We created a partnership. And so really the only options for us were either to create a partnership or to create a limited company. Now, remember what I was saying earlier about how, if you were to create a partnership, which is essentially sole trader in style, but essentially you create that sole trader under two people or more, actually. you if you go and do that partnership and create a partnership, essentially the money coming into that business, as I mentioned, is instantly yours. It also means that any liability you take on under the company also becomes yours. It's something to think about. I mean, ultimately, you shouldn't be creating a company if you feel like the company could get into some financial difficulty. But it is worth remembering, if you are creating a business, and you're creating a partnership, that should you decide to create it as a partnership, and you do fall into financial difficulty, companies can come after you personally because that debt is yours. Now, limited company, this is an interesting one. And, this is actually, what we have. Jake and I are both the directors of a limited company. There's a couple of reasons why we did that. Firstly, as I mentioned, that there's a liability aspect. I don't necessarily think that was necessary. That was something that we, was that important to us, because we knew the strategy that we had was that the company wasn't going to actually be taking on any debt. So hopefully we didn't necessarily have that risk factor to start with. The main reason really was around how we set up the company and how we draw, a salary from it. Should we decide not to take a salary from the company, i.e., depleting, the revenue, or the net revenue that we have, it's a lot easier in a limited company. The money that comes in remains the property of the company. Any obligations remain the property of the company. And in effect, the company becomes its own entity. Should somebody decide to sue the company, for example, they're suing the company, not you personally. So for the rest of the episode, I think we're going to focus on this, the limited aspect. Now, don't get me wrong. I think Jake and I might put out a video in the future talking about sole trader and partnership, what we do and don't know about that. But for the rest of the episode, really, we're focusing on starting a limited company here in the UK.
Yeah, 100%, man. And I have to echo that point. For us, it wasn't so much, the concept of taking on debt, or that we were ever worried about. I think it's that if someone was to sue you, and not that we ever went into the business with the plan or hope that we would get sued, it's that ultimately when you're running a business, you never know what could happen when you're putting your product or your name out in the public domain, right? So you want to make sure that limited liability company provides that sort of, I wouldn't say shielding, but it does help separate your assets and the company's assets, for example. All right, so I don't know if there's anything else you wanted to kind of add on that one, Rory, but
no, sorry, mate. I think so. We're getting used to this whole podcasting and YouTubing thing. I think we're going to have to create some kind of like wink or something when it's the next person's time to talk. No, apologies, mate. Over to yourself.
Oh, good. No worries. Maybe we'll get some sort of handover paddles on the go or something. Your turn, my turn, or who knows? We could make this all sorts of interesting. But so yeah, what I wanted to cover here was some of those key things you need to decide or get your head around when you're creating a limited liability company, right? So when you're starting a business, whichever method you've gone, whether you've gone sole trader, partnership, limited liability, you have to get your head around a lot, right? You've got how you're going to form that business, what finances, what website, what promo, product. The list goes on, really. Now, you can add to that when you're starting a limited liability company, a couple of other things, right? So you've got the incorporation of the business, you've got the share distribution, the corporation tax and the implications of that. Finances probably become more to the forefront. They are important in all forms of business, but when you are running a limited liability company, finances are extremely important, because there are a number of forms you have to fill out as you go through the years that are the business's tax returns or entity accounts, etc. So the list is huge, right? What we wanted to cover was some of the basics. So the first thing you're going to need to do when you're creating a limited liability company is to incorporate, right? So what you're basically doing is you're telling the UK government, I am starting this business. This is the area of business we are in, you know, what type of industry, etc. And you are incorporating that business as a formal entity. It costs around 12 to 13 pounds. I think it's currently 12. That does fluctuate, you know, year to year. The government changes that as they go, but it's around £12 a year. We will include the link to do that in the description of the video. And it's pretty straightforward, if we're really honest. You know, there's a couple of things you've got to get your head around as you do it. You know, certain things like you've got to make sure you've got your name ready at that point. Okay. Now, one of the best ways to do that is there's going to be a second link that we will include in the description of the video. And you want to find out if your name is going to be available, right? So the UK government have a database of different names that exist and registered limited companies. And your name can't be too similar to someone else's, right? So we can't go and start, or you can't go and start a brand called Nike, for example. That's just not going to fly. Or McDonald's, right? That is not allowed. Those are registered businesses, and you know, in those particular cases, they're registered trademarks as well. But you have to have a name that is different from one of those businesses or a business that exists enough that your name is unique. So we'll include, it's essentially a link that will enable you to search the UK company database with your name, you know, Joe Blogs Limited, for example, and it will tell you if that name's okay to go or not good to go. So we obviously did that. It's pretty straightforward. And once you've done that, you can move on to completing the formation. And essentially, as you go and do this, you'll be asked a series of questions, right? So it's going to ask you who are going to be your directors. So in our case, it was myself and Rory. And you know about that because the directors ultimately are responsible for running the business, but at the same time, to name yourself or name someone as a director of that business, it does carry some significance, right? So typically directors have shares in the business. At the same time, typically directors will be responsible if that business was to go bankrupt, or and that can have an implication on outside of your, you know, your direct ownership of this business. So it's not something to take lightly, but equally shouldn't be something that scares you. We just consider, you know, reading as you do that what you know, what the requirements are. You equally have to decide who else is going to have. Is there someone that doesn't want to be a director, but you know, might have significant control, aka, you know, might have some voting shares, you know, when it comes to AGMs. You know, the next thing you've got to kind of get your head around as you go through this process is called SIC codes. And essentially what they are is they're codes that determine your industry. You know, so they can be a little bit confusing because it doesn't really niche down into a specific, right? So for us, when we were looking, you know, we were going to be a coffee business. Now, you know, we had to start looking through that list and working out what was closest. You know, okay, so we're a food and drink business. Okay, great, cool. You know, you start moving down that list and working out what's closest to what it is you're going to do. You know, there isn't something that, for example, you know, I don't believe there is a SIC code that says we're a trampoline park, as an example, right? You are a activities business, or you know, that's something you're going to have to get your head around. And essentially, you know, you're looking to just make best assumptions based on what it is you know about your business at that stage. It is changeable or updatable each year when you go and file your returns. The next thing you need to consider is creating all those documents. So there are some documents that are required to not only be created, but to be held at all times at a registered address. And, you know, some of those forms include the Memorandum of Association, which is essentially the rules at which you are bringing this business together. So, you know, essentially the rules at which you formed this business. And then the other thing is, now they sound kind of similar, and this is where it can get a bit confusing, is you've got the Articles of Association. And so those two things can sound really similar and a bit confusing, but what we break those down to be is, as I said, the Memorandum of Association is essentially the rules in which you are bringing the business together. The Articles of Association are the rules that you are going to govern and run the business over, right? That's how you got to break that down. And although that sounds quite daunting, it is actually relatively easy, because when you go to incorporate that business in the process, the UK government do actually provide you basic templates that you can use that are ready to go, and you just basically sign a digital box, that says, "Yep, we're happy with these." We for our purposes, we downloaded those, read them, and there was nothing in those that caused us any problems or concerns. So we took those, we signed them, no issues. But please make sure when you go and do that, you actually read them and understand what your obligations are for running that business, okay, before you just sign the normal ones. Alternatively, you can download those, use them as a baseline, make changes as you want, and then you can upload your own set if you're if there's something that's particularly of a concern or you want added in. And then the last thing that I wanted to kind of cover was, when you incorporate that business, you have to set a company address, right? Now, so the first thing you got to do is you got to have a company address that's going to be on the public record, okay? So that's going to sit on company's house. Now, you can use, you can use a facility that is something we do, for example, to give you an address that isn't your own personal home address if you don't want that on the public record. And you can use those businesses. They are available. I believe they're called like virtual offices is what you should Google to find out more information. But the one thing to note is, when you're setting up one of these businesses, yes, okay, it's great to have a virtual office for your actual business address, but you have to declare at the point of incorporation the addresses of the directors. Now, the problem is, you then, so your address then becomes part of the public record. Now, if you don't want your address in the public record for any particular reason, and it's a fair thing to not want necessarily available on the World Wide Web, then you're going to have to go and get a director's business address as well. So something to consider. Is something we kind of hit a bit of a speed bump as we went through our process. We started and had ourselves a virtual office for the business, and then realized actually it wasn't great having our own addresses on the public record. I can't say it's the end of the world, but it's just something to consider. So yeah, I've rabbled on. I'm going to hand back over to Rory. I'm going to throw up my hand over paddle, and Rory, you're away.
Perfect. I actually, being just on the small screen today, I can't even see you at the moment anyway.
Even better.
Cool. Okay. So, I think this part, really what we wanted to do was talk about your yearly and ongoing obligations as a business and as directors of that business. The first thing really that you want to do is really look at insurance. It's not necessarily, especially if you're opening an e-commerce business and potentially you might be drop shipping something, or you might be selling something that is covered by the manufacturer's liability. We believe it's something that is important to have as a business. So you can find small business and small e-commerce insurance for around £10 to £30 a month, I would imagine. But the best thing to do is really just shop around to find that. What you're really looking to cover is two things. So firstly is public liability. So you're essentially looking to cover the impact that your business potentially could have. Could your product hurt someone? If you're shipping products, could you accidentally burn someone, if you're selling hot food or something like that? So that's public liability. The second thing is employee liability, which protects the business against the employees. Remember that as a director of the business, you are also an employee of that business. So yeah, it's something to remember. Really here, we're not experts. It's really do your own research, but the bottom line is we do think it's worth it, even though you might look at it and say, well, what am I insuring myself against? For the small costs that it's worth getting that sorted and get it sorted early on. The next thing is your incorporation fee. So, Jake, mentioned a moment ago about incorporating, but it's something to be to remember. You've got a 12 or 13 pound a year, somewhere thereabouts, liability that you need to pay for that each year. Should be minimal compared to the rest of the cost of running your business, but in interest of transparency, that's there. The other thing that's an obligation under the business, and that you'll likely at first be doing yourself as directors of the business, is your annual reporting. So firstly, you've got a confirmation statement. So essentially, your confirmation statement each year will update Companies House to let them know that nothing has changed. And really, they're not looking to know whether or not you've changed your logo. They're looking to know whether or not somebody with significant control of the business has come in or out of the business, or there's been a change or redistribution of the shares of the business, or the business address has changed. It's things like that, significant things. The other thing as well is that you're going to have your company tax returns. So remember, as we spoke about before, if you decided to go down the limited or sole partnership, the sole trader or partnership route, you'd have obligation to fill out yearly tax returns. Essentially, you still have that with a limited company, and to some extent, actually, it becomes a little bit harder. But we felt the trade-off was worth it. Up until you're essentially turning over more than 630,000, or you have 10 or less employees of the company, you can submit micro entity accounts. These are essentially a smaller version of the account, so you don't have to fill out as much detail. But trust me, it's still a lot of detail. So, you absolutely, and I'll talk about this in a second, but you need to be keeping on top of all of your expenses and all of your revenues. There's actually a tip that we can give you here. If you log into Companies House and file your confirmation statement and your tax return through Companies House first, it will push that data to HMRC. We found this out the hard way. If you do it the other way around, we went into HMRC first and submitted all that information. You then have to go into Companies House and submit all of that information again. So it's actually a lot easier to start a Companies House and allow, and then say that you want to push it through to HMRC. So there's a tip for you. If you want to buy us a coffee off the back of saving a bunch of time, feel free. The other thing, as I mentioned, is that, this is probably one of the most difficult parts of running a business, especially in the first few years, is keeping on top of your finances. So something that we think is particularly worth it is getting some accountancy software. We use QuickBooks. It's about £14 a month, something like that. It's absolutely necessary. Even if you're running a very, very simple business of drop shipping sunglasses from a Chinese manufacturer, and they're shipping it direct to the customer, you won't believe how many different financial transactions that creates. Not just the sort of buying and selling of the goods, but also say you want to market it, or you want to run some Facebook ads or something like that. You'll have advertising costs, and it starts to get messy. So if you try and do it in a spreadsheet, you'll lose track very quickly, and you won't submit accurate financial accounting, and ultimately you have an obligation, and you're putting your name to those records, so you have an obligation to do them correctly. So another tip for you is definitely get accountancy software. And QuickBooks works for us because it connects to all of our tools, it connects to our bank, it connects to Shopify, it connects to everything that you need. So it's definitely worth it. I think that kind of wraps it up really for the ongoing obligations that you have yearly. So I'll hand back over to Jake.
Boom, love it. We're getting better. We're slowly getting there, man.
Yeah.
So all I'm going to cover is the VAT concept, right? And I'm going to keep this pretty brief. I don't, we are definitely not experts, and I'll add to Rory's cautionary disclaimer earlier of, we are not tax experts. Do your own research. We are also not legal experts. So, make sure when you're signing up for stuff or signing on the dotted line to incorporate or pay your incorporation fee every year, you're doing your own research and don't just take us and trust we are 100% accurate. We have obviously done our own due diligence when we've signed these things, and we recommend you do the same. So plain and simple, VAT. Now, registering for VAT, you don't actually have to do until you are turning over. So, you know how Rory mentioned you can get away with micro entity accounts up until a certain point, and we strongly recommend you take advantage of that, because I think actually when you move out of micro entity accounts, one of the biggest things you have to have done, which I've just thought of, is I think you actually have to have them audited. So whilst you can stay within the micro entity account, you'll save yourself a significant amount of money on not having to have the accounts audited, which is a huge win. But the thresholds are quite high for that. Now, the threshold for VAT is £85,000 a year. So until your turnover is £85,000 a year, you do not actually need to register for VAT. Now, we strongly recommend that in most cases, you do not register, for VAT until you have to. So until you break that £85,000 a year barrier, we recommend you stay away from it. Not because it's not a good thing, because there are huge benefits for registering from VAT, but the extra paperwork involved and the extra stuff you need to have your head round and the extra evidence that is required is significant. And we believe that when you're growing a small business, that's a lot of extra work to take on. Now, if you've been doing your business 5 years and things are going okay, but you still haven't broken that barrier, absolutely okay. Maybe it's worth considering, because you could squeeze a lot more profit potentially out of your business by doing so. But the opinion that until we have to, we wouldn't register for VAT. And when we do register for VAT, there is a high chance we are going to be getting an accountant or some form of accountancy support, because we believe that it takes an expert to at least ensure you're doing that in a fair and legal manner. Now, one of the huge benefits when you do break that threshold and do register for VAT is that you can actually claim back any VAT your business pays. Okay, so what I mean by this is, if, for example, your business had £100,000 worth of expenses, you could actually claim back on VAT applicable products. So not everything it has VAT on it, but on anything that you've paid VAT on within that £100,000, you can actually claim back the VAT on that. So let's say, for example, in this example where we spent £100,000 as a business, if all of that was we paid VAT on all of that, we could actually claim back 20% in today's money. Obviously, that could change where VAT prices go up, down, left and right, who knows. But today, we would be able to claim back £20,000 worth of expenses, essentially. And ultimately, that's great, right? You're going to increase your margins potentially by doing that. It's not perfect. That's a pretty rudimentary example. But yeah, basically, we recommend you don't register for VAT until you have to. And when you do, we recommend making sure you do some significant research on that, or you seek some professional advice. Yeah. But yeah, that's all I've got to add on VAT.
Cool. Okay, cheers, mate. So I think, to be honest, we'll probably leave it there. We've thrown a lot at you guys in this short space of time. Hopefully you found that useful. If you did, consider subscribing on YouTube, or subscribing if you're listening to us on the podcast. We're going to be in both places. So actually, if you're listening to us on a podcast, why not come over to YouTube? Come and see us on there as well. Why not? you know, we're just starting this out really. So we're going to be reading comments avidly. So if you've got something that you want to know, if you've got questions about what we've just said right now, or there's, you know, some ideas that you have for additional things that we might be able to put out an episode on, please drop us a comment below. And then if you like coffee, why not check out one of our businesses, which is Caffeinate. We'll put the address in the description below, but why not check out our coffee on there? You know, maybe we're biased, but we think it's incredible. So why not try that out? And so, yeah, finishing there. See you next time, I guess.
Welcome to episode 2 of caffeine-fueled adventures. Have I got that right?
Yeah, almost.
Caffeine-fueled adventures, isn't it?
That's the one.
Start again.
No.